Moving average is a very important indicator in the day trading. It can show you the trend direction, the change of a trend direction, and it can also serve as the support and resistance, so you know when is the good timing for your entry. So in this video, I'm going to show you how to use the moving average in the day trading. Let's get started. I'm going to cover the following topics. Number 1, moving average basics. I'm going to show you the basic knowledge about moving average. Number 2, how to use exponential moving average in day trading. Basically, there are two uses of it. The first one is to use as the reversal setup. The second is to use as continuation setup. Number 3, I'm going to use 3 examples from currency, cryptocurrency, and also futures to show you how to apply EMA in day trading. So what is moving average? Moving average is when the current bar just finished the average close price for the previous and finished bars. Here, we should pay attention to some keywords. The first one is this, just finished. That means only when the current bar is finished, the moving average for the current bar will be calculated. That means this moving average is a lagging indicator, so it doesn't have much forecasting power. This is something we need to pay attention to. The second keyword is this average close price, which means if it is average, it is a smooth of the trend. For example, if there's 1 or 2 outliers, it won't impact the moving average much. The third keyword is the number n here. So basically there are 2 implications. The first one is when n is a large number, a sudden price move won't have much impact on the moving average. However, if n is a small number, the sudden price change will have much more impact than the larger number on the moving average. The second implication is that n is a number larger than 1, so there are a lot of options for you to choose. So that's why it is very hard for you to find out the right one to fit your strategy and trading style. There are mainly 2 types of moving average. The first one is simple moving average, and the second one is exponential moving average. Let's take 10-period moving average for example. So here shows the weight for all the 10 close prices. We can see the weight for each one of them is exactly the same, so the moving average is calculated as the mean of the 10 close prices. For exponential moving average, we give more weight to the most recent bars. Here, for example, 1 is the current bar, so we give the most weight to it. This makes sense because the most recent bar close price will have more impact on the trend. This is only a demonstration of the weight here. For more details of the calculation, you can search on the internet to find out the formula for calculation of EMA. Just because of this characteristic, EMA is a better indicator than SMA in telling the market strength, so a lot of traders will be using EMA rather than SMA in their trading. We'll be using EMA as well in this video. For the number n in EMA, mostly there are some numbers that are used frequently, like 10, 14, 20, 50, and 200. So for 10, 14, and 20, most of the time they are for the short-term trending, like in the lower time frame chart, 5 minutes, 15 minutes, 30 minutes. And for 20, 50, and 200, most of the time they are used in the long-term trading, like in the chart 4-hour chart, 1-day chart, and also weekly chart. However, you can also customize of the number n in your trading strategy. It doesn't matter which number you have, as long as it fits your trading style. What general information can EMA show us? There are 3 scenarios. The first one is when the price crosses the EMA from below to above and then stay above the EMA. And at the same time, this EMA curve is an upward sloping curve. This means the market is in an uptrend. On the other side, the second scenario, when the price crosses the EMA from above to below and stay below the EMA. So the EMA is having a downward sloping. This means the market is in a downtrend. The third scenario is for the trading range. If the price crosses the moving average multiple times, so the EMA is staying as a flat curve, so that means it is a trading range. However, even if we don't have the EMA curve here, by just telling the higher high, higher low, or lower high, lower low, we can also identify the trend. Let's move on to the second part of this video, how to use EMA in the day trading. There are mainly two ways. The first way is to use as the reversal setup, and the second is to use as the continuation setup. Let's first take a look at the reversal setup. So for this setup, we need two EMAs. One is the short-term EMA. Here we use the 10-period EMA. The other is long-term EMA. We use the 40-period EMA. So the concept is like this. So when the short-term EMA crosses the long-term EMA from above to below, that indicates the trend changed from upward to downward. So here's a good example that after the crossing here, the market moves to a downward trending. It is the same situation that when the shorter EMA crosses the longer EMA from below to above, that could indicate a trend change from downward to upward. Now let's move on to the trading range. So here we have a downtrend, and then we have multiple crosses here. Here is one, another one, the third one, and the fourth one. However, we can see that in the whole chart, it is in a trading range rather than a trending. If you enter a trade, there's a possibility that you could get stop loss rather than getting a profit. So this is one of the drawbacks to use this reversal setup. Now let's have a summary of the reversal setup. There are two things. The first thing is, in this reversal setup, we need two EMAs. That means we need two parameters. So whether you choose 10 and 40 or 20 to 50, it's hard to decide. It really based on your back testing. However, even if you have 10-40 for the first half of the year, but in the second half of the year, it may not work well. So that it decreases the probability of winning trade. Second, so we can see the market is not always in trending, and most of the time it's in the trading range. And the two periods of moving averages cross each other will reduce the probability of giving you a good indicator for trending. So that's why this reversal setup is not suggested to be used by the beginner day traders. The second setup is the continuation setup. Here, the EMA acts as the support and resistance. There are three scenarios. Let's take a look at this chart first. So it is an uptrend here, and then it pulls back. The market touches the EMA. And then we see this bull bar as the signal bar to enter the market. And then as the market moves on, you can see it pulls back again to touch the EMA again. So we can find out the signal bar like this bull bar and also this bull bar to enter the market. The second scenario is when the market crosses the moving average. Let's take a look at this chart. The market moves up and then it pulls back. So we can see the signal bar, this bull bar, and also this bull bar, they are across the EMA. And the same thing here, so the market pulls back again, and then this signal bar is across the EMA. So we can enter at the top of the bull bar to enter the market. The third scenario is the market penetrates the EMA. So here's the example. The market goes up and then pulls back here. So all the bull bars as the signal bars are below this EMA. So, but they can also serve as signal bar for you to enter the market. Another thing you should notice is that you can adjust the number N to make the EMA either it is touch, across, or penetrate. So it really depends on your strategy and based on your back testing. For EMA in the continuation setup, there are two scenarios. The first scenario is if there are other indicators or other setups then this EMA is a very good confirmation to the start of the trend, which will increase the probability of the trend start. And the second is that if there's no other existing techniques or tools or indicators, you can use the EMA alone as the support and resistance. And then this will also increase the probability of the trend start. And this, the second scenario, is the true value of the EMA, and I will show you in the following examples. Now let's move on to the last part of the video, the EMA examples. Let's first take a look at this GBP and CAD. Here we have a trendline break, and then we'll wait for the pullback to trade until we see a signal bar. Here comes the bull signal bar. However, it didn't get triggered. Here's another one. It didn't get triggered. The reason that we can use this bar as the signal bar is because there are 7 consecutive bull bars here, which means strong market. So the requirement for the signal bar is not that much. And then the market comes down to the EMA as the support here. It crosses a little bit. So this bar is a very good signal bar as well. And then this time the market triggers and then goes upward. However, if you look at this chart differently, we can notice there's a previous high. And then if we draw a horizontal line here, this line can serve as the support or resistance. So basically the previous high-low can do the same thing like a support and resistance for the following market. And here the market comes down to touches the support line and then resumes. We can definitely see that the market comes down here, touches the support line, and also at the same time it is touching the EMA here. That means EMA here serves as the confirmation of the start of the trend. Now let's have a look at the second example, the Bitcoin. The same situation. We have a trendline break here, and then we wait for the market to go back to the EMA as the resistance. Here comes 2 very good signal bars here, and then the market resumes downward. However, if we take a look at this chart from another angle, we can say that this trend line also serves as the support or resistance level as well. The market comes back to test this resistance as the trend line, and then it failed, so it moves downward. And the EMA here can serve as the confirmation for the start of the trend or the start of the entry. Here comes one question on these 2 examples. If we remove the EMA from the chart, can we still trade and capture the market? The answer is yes, because trendline and the support resistance levels are more reliable than EMA. However, the role EMA plays here is as the confirmation of the trend start. So you can see the percentage of EMA plays in this trade is not that much. Now let's have a look at the third example, which is the ES-E-mini S&P 500 futures. Again, we have a strong breakout here, and then we're waiting for the pullback to trade upward. And you can see the market goes down here to touch the EMA, and then this bar can serve as a very good signal bar. And at the same time, for the second pullback, these 2 bull bars can serve as the signal bar as well. And then this time, the EMA acts as the support. The difference between this example and the previous 2 examples is that in this chart, there's no other indicators like the trend line or the resistance and support from the previous high-low to act as the support for this signal bar, purely using the EMA here. So this is what I mentioned as the true value of this EMA in the day trading. Another thing to mention is that, let's say for this bar, right now we are seeing it's touching the EMA. However, in the real-time trading, when the bar is still developing, you won't see it's touching. For some platforms, you won't see the EMA is under this bar, and for other platforms, you will see that the EMA here will be changing based on the bars developing. However, based on your experience, you can forecast whether it's gonna touch the EMA, across the EMA, or below the EMA. So you can make a decision on whether you want to enter. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you.